I think fundamentally, the drivers of gold for the last 3 years, led most importantly for central banks, they continue to buy. They have not gone away. And if you're buying, if you're selling a dollar and using some of those proceeds to buy gold because you're worried about the concentration of your reserves in a single asset issued by a fiscally irresponsible government that is prepared to weaponize its dominance, has anything changed? Nothing has changed. So central banks are continuing to buy gold. People concerned about fiscal deficits are continuing to buy gold. What's new, I think, are two things. One is can we say chaos? I think we can, but certainly the uncertainty generated by the current administration in the US has added to the gold buying. No question about that. It's not one particular thing. It's not Venezuela, it's not Gaza, it's just the general sense of uncertainty and not knowing what's next. Look, a pullback is always in the cards, and people forget. Everybody talks about, well, not everybody, but you talk about it as 1974 to 75 when gold dropped almost 50%. But people forget the same thing happened in 2006. Halfway through the bull market, you had a 30% correction in gold, which of course means a much bigger correction for gold stocks. So a pullback at some point is always not just a possibility, but it's almost a certainty. But if we rephrase the question to, is this a top, absolutely not. In my view, we are absolutely nowhere near a top. And we can talk about the things that are driving gold, and I'd like to do that. But what's missing from this market is generalist investors. They are not in this market. Everybody looks downstairs at the conference hall and says, oh my gosh, all these people. But they're all gold investors. Where are the generalists? This might blow your mind, I don't know, unless you've looked at it. The GDX, which is the largest ETF of gold miners in the world, the GDX has had net outflows in the last month. Net outflows. And of course, for the last 3 months, 6 months, and last year, it's had outflows. But even now, people are not buying. The generalist investor is not buying gold right now. So I think, so you can't have almost by definition, you can't have a bubble that bursts without public participation. And we simply don't have public participation.
Okay, not yet. The lines were looking pretty long here today.
But these are all gold investors. Yeah. I bet you if you went up that line and said, how long have you been investing in gold? There's very few of them would say, oh, this is my first year.
Despite rising prices, gold remains a niche asset in investor portfolios. The broader public, so-called generalist investors, are largely absent. This is visible in persistent outflows from major gold mining ETFs, even during strong price performance. That contradiction matters. True market bubbles require widespread participation, enthusiasm, and leverage from non-specialists. None of that exists here. Conference halls may look crowded, but they are filled with long-term gold investors, not newcomers. Without retail momentum, speculative leverage, or institutional crowding, it is mathematically difficult for a bubble to form, let alone burst. Gold's advance is happening quietly, not euphorically.
I think fundamentally, the drivers of gold for the last 3 years, led most importantly for central banks, they continue to buy. They have not gone away. And if you're buying, if you're selling a dollar and using some of those proceeds to buy gold because you're worried about the concentration of your reserves in a single asset issued by a fiscally irresponsible government that is prepared to weaponize its dominance, has anything changed? Nothing has changed. So central banks are continuing to buy gold. People concerned about fiscal deficits are continuing to buy gold. What's new, I think, are two things. One is can we say chaos? I think we can, but certainly the uncertainty generated by the current administration in the US has added to the gold buying. No question about that. It's not one particular thing. It's not Venezuela, it's not Gaza, it's just the general sense of uncertainty and not knowing what's next. And then the other thing that's incredibly important is Tether. Tether, which is a stablecoin company, what are they, the 8th or 7th largest holder of US treasuries in the world, with a US stablecoin, but now, as you know, they've introduced a gold stablecoin. Tether bought more, in the last 2 quarters, Tether bought more gold than any other single central bank. If you rank the central banks and put Tether in, they were the #1 buyer of gold. To me, that is incredibly important because, for 2 reasons. One is Tether's plans and goals are to see the gold stable coin grow as rapidly. They think the gold stable coin will grow as rapidly as the dollar stable coin grew in the last 5 years. So that's tremendous growth, and that has to be backed by gold, right? I mean, every gold stable coin has to be backed by physical gold. They already have over 20 million ounces of gold. That's a lot.
The most powerful buyers of gold today are not hedge funds or speculators, they are central banks. For several consecutive years, official sector purchases have remained elevated, reflecting deep concerns about reserve concentration, fiscal discipline, and currency weaponization. These motivations have not faded. Governments continue to run persistent deficits, debt levels continue to expand, and geopolitical fragmentation continues to accelerate. Gold functions as neutral money in a polarized world. For reserve managers, it is not a trade, it is insurance. And unlike past cycles, these buyers are price insensitive. As long as monetary credibility remains strained, central bank demand provides a durable floor under the market.
So they're going to be continuing to buying gold and also continue for the mining sector. What's important is continuing to look for sources of reliable gold. So they've been trying to get offtake agreements with major miners, but they're also buying royalty companies, for example. But they're going to continue to be a buyer of physical gold, I think. And the other thing that's very important, the other consequence of Tether buying gold, is how can I put it? It legitimizes gold for the crypto crowd. Because the Bitcoin crowd, the crypto crowd who thinks gold's outdated, gold's a pet rock, Tether is our hero, look at what they're doing, and then suddenly Tether buys gold. Well, that is an endorsement for gold for the crypto crowd. What I think could happen, I won't say will happen, but could happen. I think Tether will continue to buy gold, but I think what could happen is that the volatility that we're seeing in Bitcoin really tells us that it's not a store of value. It might be a lot of different things, but it's not a good store of value. And if I'm in Bitcoin and I've gone from 130 or whatever it is to, what is it today, 75 or 80, and gold has gone from 4,000 to 5,000, I might be thinking maybe I should switch some of my Bitcoin into gold. I think you're right, but I mean, this is incredibly significant. I mean, as I say, the facts are facts. Tether bought more gold than any other single central bank for the last 2 quarters. That is, and by a large margin, that is meaningful. And if they can, and Juan Santori, the chief of, what do they call them, global projects, he's the one for Tether. He's the one driving this gold force. If he thinks that the gold stablecoin is going to grow tenfold over the next 5 years, and he has said their biggest concern is finding a steady supply of gold to back the stablecoin. Their plans may not come to fruition, of course. They could be wrong. But I think it's incredibly significant, and people should really pay attention to it.
A major structural shift is emerging from an unexpected place: digital finance. Tether, one of the largest stablecoin issuers, has become one of the world's most aggressive gold buyers. Its gold-backed token requires physical bullion for every unit issued, creating direct demand for metal. Over recent quarters, Tether's purchases have rivaled, and in some periods exceeded, those of individual central banks. This is significant not only for volume, but for symbolism. Gold is being integrated into blockchain-based settlement systems, legitimizing it for a new generation of investors. Tokenization does not replace gold. It amplifies its relevance.
If you look back, Gaza didn't really move gold. Ukraine, it moved up for 2 weeks before, then it fell back for 2 weeks afterwards. You're absolutely correct. If you look back over the last 40 years, geopolitical events have really not had a lasting impact on gold. What's happening now is something different. Gold is moving up not because of Venezuela, not because of Gaza, not because of Iran, not because of XYZ. It's because of all of these things happening and the uncertainty of what's next. So if you look at the motives, why are people buying gold? Because they don't like fiscal deficits. They don't like all of the debt in the world. They don't like the loose money and the excessive monetary creation. They don't like instability and uncertainty. None of that has changed in the last 12 months. And is any of that likely to change for the better in the next 12 months? I don't think so. Stock market rollover, I think, is most likely to be the catalyst. If you look at the leaders, the big tech leaders like NVIDIA and Microsoft, they've gone nowhere for 3 months. But if you're a regular ordinary investor with a 401k plan or whatever, and every month you open your statement, it's still increased in value. So you don't look at what NVIDIA's done in the last 3 months. Your S&P, your S&P has gone up. When that stops, when the investor stops seeing his S&P or his 401k go up month after month after month, then the investor says, where else should I put my money? And
Extreme volatility has reignited an old debate. What truly functions as a store of value? While digital assets offer innovation, sharp drawdowns challenge their defensive role during periods of stress. In contrast, gold's performance has been comparatively stable and directional. This divergence matters. Investors do not abandon speculative assets overnight, but capital rotates. Even small reallocations from highly volatile instruments into gold can have outsized price effects due to gold's relatively tight supply. If confidence in alternative stores of value weakens, gold stands ready as the historical benchmark. Not as a replacement, but as a stabilizer.
There's lots of places I should go. You look at international markets. International markets, most people don't know this, or a lot of people don't know this, I should say. If you look at the Morgan Stanley World ex-US Index, which is the benchmark, that went up 32%, over 32% last year, and the S&P was up 17%. The world markets almost had double the performance of the S&P. That is the first time in 16 years that the global markets have outperformed the US. You've got the global markets today at the lowest relative valuation to the US market that they've ever been at. Let me just say that again. Global markets, international markets are at their lowest valuation relative to the US market that they've ever been. Value stocks are at a 30-year, 20, 30-year low relative to growth stocks. Small cap stocks are at a multi-decade low relative to big cap stocks. So all of these things are beginning to turn. I mentioned international, which is the obvious one. They doubled the performance. But all of these things are beginning to turn. And these things typically, you don't have international markets outperform the US for 1 year and then revert, just as you don't have the US market outperform for 1 year and then revert. So I think we've got 5, 6, 7 years ahead of us of outperformance by international markets. And that's all helped by a lot of international economies, particularly the smaller ones, are doing better than the big cap, than the US. You've got the dollar falling, which of course the dollar falling means that if I'm a foreign investor...
Beyond gold, global markets are entering a period of rotation. International equities have begun outperforming US markets after more than a decade of underperformance. Valuation gaps between growth and value, large cap and small cap, US and foreign markets sit at multi-decade extremes. Meanwhile, concentration risk in megacap technology has reached historic levels. When momentum stalls and passive gains slow, investors search for alternatives. That is often when capital redistributes into undervalued assets, real assets included. Gold does not need crisis headlines to rise. It only needs continued imbalance. And those imbalances remain firmly in place.
When the dollar falls, yeah, I can buy something cheaper, but if it continues to fall, my returns are lower. And U.S. investors in particular are so U.S.-centric, but it's true for investors in every country. You don't really look at the currency, because if you buy X and it goes up 20%, you think you're up your 20%. Even if the dollar fell by 30%, you still think you're up 20. But for a foreign investor, that's very, very significant because it affects their returns. And so foreign investors who have been pouring money into the US market for the last 12 years, pouring money in, to the extent that a lot of international investors and pension funds and institutional investors in the UK, Switzerland, and elsewhere, they'll have 40, 50% of their assets in the US. That money is now flowing out. And the only reason, in my view, the only reason that money is continuing to come into this market is AI, because the US is obviously the world's leader in AI at the moment, and certainly, I mean, China's doing a lot, but companies, in terms of companies, if I'm an investor in Switzerland and I want to invest in AI, it's the US market. Once you remove that as the incentive to invest in the US, then I think the US market falls dramatically relative to the foreign markets, and we're very close to that point. I mean, you look at NVIDIA. Nothing against NVIDIA. I'm not even going to say whether it's a good company or a bad company. Let's say it's a great company. NVIDIA's market cap today is greater than the market cap of Britain. It's almost twice the market cap of Canada. It is greater than the market cap of every small cap company in the world. Does that make sense? There's something missing there. You could have Singapore, Switzerland, Sweden, Spain. You could have all four markets for NVIDIA. So I think so in other words, that's an example, that's an illustration of just how overvalued it is in my mind. You didn't ask me about AI, but I guess I'm telling you. Anyway, there's a lot of reason to think that AI is overdone. So even if in 5 years' time AI is the greatest the greatest thing since the internet, are the companies that are so overvalued today going to continue to grow? We could go back to the year 1980 and think of who were the leaders in the internet back then. Half of them don't even exist as companies anymore.